compared to everybody else.
Okay, why don't you start? I'm turning the timer on, yeah?
Okay. Hello, welcome to ThinkTech TV. I'm Charlie Willson. Today our guest is Kalbert Young, Director of the State Department of Budget and Finance. We're in the final 3 weeks of the state legislature, and we're going to have a discussion here about what the status is of budget and finance talks and where we're going in the future. So let me turn it over to you. Thank you for joining us.
Well, thank you for having me on, Charlie. You know, we're at the final stages of the state legislature. It's been a very interesting session. There's been a lot of issues that have been discussed. What's really important about this legislative session is that it represents the first session where the state's really coming out of the recession. There's a lot of positive, upbeat attitude. There's revenue to support a number of new initiatives. You're seeing a lot of that discussed at the legislature. You hear a lot of talk in the newspaper or on the radio and read in the newspaper about early childhood education, for instance. The state getting a handle on unfunded liabilities that have been really gone without address for the last several decades. And looking at new initiatives, you got collective bargaining on the horizon as well. So right now the legislature is trying to balance all of that in the composition of a budget. I think for taxpayers it's a good thing to recognize that the state's really coming into the economic upcycle, and when we look at what programs are going to get restored, we should really ask ourselves, are we going to be able to sustain those programs into the down cycle? Because that's really the financial structure and policy that you're going to want to be aware of. How do you build a government and services that are sustainable into the long term?
So basically, you're looking at funding programs while the economy is down, while you're going to get better interest rates, and while you're going to get perhaps better prices on bids for construction activities and programs going forward?
Mm-hmm. Well, that's one very big aspect of it, because Governor Abercrombie had laid out a pretty aggressive and robust campaign of supporting the local industry and economy by encouraging job development, most notably in construction, of course. Mm-hmm. And the state government has followed up by trying to fund a lot of capital projects over the last 2 years. Right now, capital markets are very attractive for borrowers like the state to fund these capital programs. Interest rates are very low, historically low. But also we can benefit from good job growth. So for Hawaii, our local construction industry is still trying to get and take hold and climb back into the upcycle of the recession. The economic recovery coming out of the recession. So there's very good cost for construction jobs. There's also very good access to capital. So we want to take advantage of that. For the taxpayers, the benefit is you're seeing your tax dollar stretch a lot farther right now, even as the economy starts to pick up.
Yeah, we like the sound of that, stretching
Yes.
the tax dollar a little bit further. Could we break this down just a little bit and talk about how is tourism doing as a contributor to the recovery here, and then maybe we can talk a little bit about construction as well here.
Sure. Well, tourism has led the way over the last 24 months coming out of the economic recession for Hawaii. Right now, as we sit here in April of 2013, we see Hawaii coming out of a banner year for tourism in 2012. Record number of visitors, record number of average room occupancy, record number for average room rates and revenue per room. And so we've really stepped into 2013 on a high mark. And that's all good. And the projections going forward, at least for the next several years, look very optimistic and positive that we will have good, long-lasting numbers on tourism. The problem with that is that when you see us at the peak right now, where tourism is at 90% occupancy on Oahu and climbing towards 80% occupancy on all of the neighbor islands, we've really tapped out in terms of capacity for growth in that industry. We're running at full speed on tourism. There's a little bit room to grow maybe over the next couple of years, but after that, we should not plan that we're going to see double-digit rates of growth in that industry anymore. We will be running at full capacity, full steam at that point. So the question really is, well, what industry or what portions of the economy will help take over to the next leg and allow us that boost to take us beyond the next 2 years? And that really is the construction industry, which has been lagging at least for the last couple of years in terms of growth, but it's really starting to pick up steam. We have a lot of expectation that rapid transit will help contribute to that job growth from construction, but you're seeing residential and commercial development also starting to come back and pick up. That's a little bit slower bleed time to get fully up to speed, but beyond 2 years, we expect that could be the next driver to keep the local economy running for the next 5 years.
That sounds really good. As long as the interest rates are down and we're getting great bids on construction contracts, it sounds like a very good time to be working construction projects. Perhaps we could look at this in terms of sustainability past the next couple of years. Obviously, interest rates, as the recovery continues, interest rates will come back up a little bit. And your emphasis right now is to look for the economies of scale and to get the projects in motion while the costs are down. And then as employment comes up, we're getting a more sustainable recovery.
Yes, exactly. And for stimulation like economic drivers in construction, you can't start these projects on a dime. It takes a lot of lead time to get them appropriated, planned, funded, and into the ground. So there's a fair amount of time that you have to anticipate ahead, and we want to do as many of them as we can before interest rates start creeping up significantly back on us, before the cost of constructions just start ramping up on us again. But it's all, again, to the benefit of trying to encourage job development and sustainability of construction jobs. These industries also contribute to a lot of diversification of new industry growth in Hawaii as well, and trying to seed those diversified new industries so that in the long run they can grow and blossom and help become economic contributors. That's really the end game for Hawaii.
What new industries are you referring to specifically? What do you put high hopes in?
Well, I really am hoping that Hawaii will invest significantly in IT infrastructure that can spur a lot of high intellect growth, high technology growth. We have a very good geographic situation for Hawaii, being where we are located in the Pacific. Relative to Asia, Polynesia, and the U.S. mainland, we have a very good nest or bed for a good research university, and there's a lot of intellectual stimulation and development there. But what has been sorely lacking over the last decade or so has been an investment in IT infrastructure that would allow these high growth companies to want to seed here in Hawaii. It's one of the reasons why a lot of these companies will actually bed up in the U.S. mainland west coast, or actually now you're seeing them bed up in Asia, and even in Southeast Asia, just because there's a lot more infrastructure. I'm talking about high bandwidth capacity, a stronger commitment to internet development. What we should want to do is invest in providing this IT infrastructure, this internet infrastructure, and allow for these high growth companies, incentivize them to want to locate here, because intellectual property is really the next growth area that I think Hawaii could benefit from.
That's a really good point. Hawaii is a very interesting position in that we're really the only state that can do business both with China, Japan, the East, in the same business day that we're doing business with the U.S. mainland. So our time zone gives us a very unique advantage. Now, you talked about investment here. Can you give us an idea of the type of investment that would be required and perhaps what the state role would be in that investment?
Yes, so right now, a very significant project that we are looking at is capitalizing a landing sites for high-speed cable, internet cable from different parts of the world to land here in Hawaii. There's really been no investment in that type of infrastructure in Hawaii for several decades, and the architecture that brings the internet to Hawaii is running through fiber optic cable that's aged, nearing end of its life cycle. The state of Hawaii and its private partners should look at ways to reinvest to make sure that Hawaii stays contemporary with the type of infrastructure that it has. Governor Abercrombie, as part of his New Day plan, had actually set a marker to try and get 1 gigabit per second speed in Hawaii. That's a very tall order, even for the U.S. As a country to try and get there for any large metropolitan area. But it kind of signals where we have to be. You see a lot of Southeast Asian cities have actually exceeded that as their marker for their goal. So if Hawaii and the U.S. wants to stay competitive with the rest of the world, certainly with the other countries in the Pacific region, we need to stay at least on par with trying to advance ourselves to where these other places are trying to get themselves.
Good point. In terms of the state role in this, can you give us an idea? Would the state be looking at a public-private partnership, perhaps, or are we just doing some of the footwork to make private investment more viable here?
Well, it starts all with a partnership between the private and the public sector. So what form that takes, it's really at the discretion of the private sector to dictate what is it going to take for them to reinvest in Hawaii, bring this type of architectural infrastructure to Hawaii. The state can step forward and do a lot of things that really don't amount much in terms of cost to the taxpayer. For instance, one of the big hurdles to private investment is just the entitlement process, meaning permits, approval processes for government, whether they be county or state. Those types of processes are often very cumbersome and they're very long. And long in the sense it could take several years to get the right entitlements for private sectors to want to even put anything into the ground. Years is, could expand past an economic cycle when you're talking about when is the next upcycle going to come or when's the next down cycle going to hit us. So we want to be prepared. We can do a lot of things to make it easier for private investment to occur. We could also contribute monies as taxpayers to help share in part of the costs, and that will help incentivize greater private sector development. So if this public sector and the taxpayer could get a 3-to-1 match from private sector funds to public dollars, that's a very good return actually for what we could actually do as a state to providing what's the next evolution of our economy. So
to a certain extent, we would be priming the pump a little bit to get the ball rolling.
That's a very good way to put it. I think I would agree, yes.
Okay. In terms of cables that are currently close to end of life cycle, is there a degree of urgency here? Does this need to get going within a certain time window? What's the current status here?
I'm not a total techie in this regard, okay. But the reports that I've seen, there is an urgency that's at stake. We need to get something developed within the next 5 to 10 years to ensure that Hawaii continues to maintain the level of bandwidth capacity that will drive what our local statewide needs are, but also where we want to get. The rapid development of increased data that's being transmitted both within and to out of state, we're really reaching a capacity that we need to build something new.
Okay, two other questions come to mind. One is there a role that UH can play in assisting with this? And the second, unrelated kind of question is, what kind of a multiplier effect might you see on Hawaii-based businesses? Because anytime there's a certain amount of investment, public investment usually will get a significant return on investment if it's put in the right places.
I don't have no idea with terms of the specifics of a multiplier, but definitely I think University of Hawaii is a good driver there because they have both the intellectual capacity. They bring a lot of partners that are primarily in this space that are really dependent upon high bandwidth. So I think they will be one of the key drivers there. I think local development of innovators that are out there, app developers, for instance, could also drive a lot of the desire and need for this capacity. So there's a lot of players, I think, that once they realize where the state is, our state legislature and Governor Abercrombie's administration have really been looking at trying to fund a way to get this type of development. I think that industry will really start to take a look at percolating up innovators and advocates to support this move.
Do you have any preliminary ideas you'd like to share with us as what's being discussed as far as getting some of these people to come in here and look very seriously about locating in Hawaii?
The Department of Business, Economic Development and Tourism, Director Richard Lim, has been at the forefront of trying to bring a lot of partners on multiple fronts, trying to bring them together, identify what are the needs, where are the interests for investment, how the state can actually be a partner and help facilitate this. So there's a lot of different areas.
That sounds really good. I'm impressed. I like to see that forward-looking agenda here where you're looking at the long-term future. Maybe we can come back just a little bit and talk about the current budget discussion. Now, the state budget goes for 2 years, correct? So we're looking at a 2013 to 2015 budget. And there's a couple of elephants in the room here regarding unfunded liabilities. Can you tell us where we are in terms of the unfunded liabilities right now?
Sure. Well, there's two very large unfunded liabilities for the state of Hawaii. The first is in the pension system. The Hawaii State Employee Retirement System, or the ERS, funds the pension of all state and county retirees. That pension system has about a $9 billion unfunded liability. It has roughly about $12 billion worth of assets, but its total liability is somewhere in the neighborhood of about $20 billion. So therefore, about a $9 billion unfunded liability. Now, every governmental employer, being the state or the counties or the city, pays into the employee retirement system a portion of their payroll. So in that sense, the pension system is what is considered pre-funded, in that we're paying money into the system ahead of when the pensions will be paid out. Much like how people will think Social Security is. But like Social Security, it's not like that at all. You're not pre-funding anything. You're paying into the system and you have exits out of the system, you're paying pensions. So the money is really being cycled through there, and whatever you can invest and get a rate of return, that helps build the corpus. So right now the pension system is about 59% funded. It is one of the worst funded pensions in the country, but we're not alone in that there are a lot of underfunded pensions, government pensions. What the state of Hawaii has been able to do over the last 2 years with the legislature is to pass a number of pension reforms that will increase funding to the pension system, reduce pension benefits for new employees. All of that should help over time turn the funding duration of the pension system into a longer, more fully funded pension system. It also will reduce the unfunded liability, but this takes a lot of time because you don't correct $9 billion worth of underfunded pensions overnight. So as bad as the pension system is, it's actually in a very good position right now because of 2 years worth of hard work and foresight by the legislature and the administration to reforms in there. The real problem is right now where we've shifted our focus, and this legislature, you've seen a lot of discussion on it, is in the unfunded liability of the Employer Union Trust Fund, or the EUTF. That's the trust fund that provides health insurance coverage for active and retired employees of, again, all the state and the counties and the city. The EUTF has an unfunded liability of about $18 billion, of which somewhere between 15 to 16 billion is all the liability of the state of Hawaii. And what's really bad about the EUTF is that it's effectively 100% unfunded. There's maybe only about $200 million to $300 million worth of assets in the EUTF, and those are largely due to contributions from some of the counties and the city since 2008 to what's called pre-fund their future liabilities. The state has not pre-funded anything, and it has the lion's share of the liability there. This is a liability that grows exponentially every year. Since the state hasn't pre-funded, it now stands at about somewhere between 15 to 16 billion. Actuarially, if the state had to fund it like it should a mortgage, let's say for 30 years, which is what the actuarial timetable requires, on a 30-year accrual, it would take the state, it would take us to have to contribute about $520 million a year to pay off the liability in 30 years. Well, over the last 2 years, the Abercrombie administration has been trying to get better intelligence and education into the legislature about the need to fund this liability. It's been 2 long years. It's been a lot of discussion. The financial condition of the state arguably wasn't ripe in order to have that executed. But what we're seeing this legislative session is that the legislature, as we speak today, Charlie, has continued to push forward the administration's proposal to fund up $100 million each year for the next 2 years towards the unfunded liability in the EUTF. Now, I did tell you that the true amount should be like 500 plus million, but the 100 million actually represents a good first step for Hawaii, considering that we haven't been able to get the legislature to fund anything at all, and the state itself has not funded anything at all for decades. So 100 million, while small in comparison to the total liability, is a very, very good step and should be very well received by Hawaii's investors, the credit markets who look at Hawaii, and it's a significant milestone if the legislature does happen to pass the budget with the admin's proposal still in it.
So the bottom line is that right now we're paying in $100 million a year, and this is a little better than paying off interest alone, but it would be a very long time to pay back. And what you're saying is that if we can raise that to $500 million a year, that puts us on a level with, say, a 30-year mortgage, so we will be paid off. So as taxpayers, we should be trying to support the 500 million level to bring us back onto a more sound financial footing. Would that be correct?
That's what I'm asking taxpayers to understand.
Okay.
This is not, it's not cheap by any means. It would have been cheaper had the state gotten on a pre-funding track decades ago, like it should have.
Yeah.
But it is immensely cheaper to start dealing with it now than if you wait 10 years. Because this liability is growing exponentially. It's like your mortgage in the sense that if you miss a mortgage payment 1 month, you cannot double up the following month and think you're going to catch up. Interest has accrued. So if the longer you wait, you will never catch up. And that's the situation Hawaii has been in. And that's why the liability has grown to be so much, and why the amount that you have to start paying is so much now. It's painful, yes, I admit it, but it's going to be immensely less painful than if you wait another 10 years to do it. And I don't know if Hawaii even has the luxury of waiting another 10 years. This is a responsibility that the state should have been on decades ago. We're not recommending anything that shouldn't have been recommended before. All we're asking is that for the state to start demonstrating the fortitude to deal with its obligations, and we have to get on a plan to get there. We can't get there overnight. Again, 500 million is a lot of money to expect, so it takes some time. But I think right now you're seeing the legislature understanding what this liability means. We are seeing the economy come back, so there's still this opportunity to afford some of this discussion now, and maybe that hasn't been there the last 2 years. So we're seeing a lot of opportunities for change and addressing some of these challenges that have been existing for a long time.
So at the current funding level, at about $100 million a year, what we're doing is we're keeping we're keeping the balance from increasing. We're staying ahead of the game slightly, but we're not really paying off our principal.
Yeah, right. We're not paying off the principal. This is equivalent of doubling up on your minimum monthly payment on your charge card. You'll get ahead. You'll get there eventually, but it may literally take us more than 100 years to get there at this rate.
Okay. All right, that's good to know as taxpayers, because I want to know what it takes to get it back on a footing that's consistent with what would normally be expected in the financial markets. Okay, let's deviate just for a little bit. When we talk about the healthcare fund, is there going to be an impact here from Obamacare and the decisions here which change the way healthcare is administered? Is that going to have an effect on the state budget?
I would say yes. Yes, I mean, that's pretty obvious. But whether that impact is going to be in the tens of millions or the hundreds of millions, we still have yet to really see. We know there's going to be an impact. There's already starting to be an impact in terms of our Medicaid programs. Knowing how much coverage is going to have to be provided and who's going to need coverage out there, that's already showing signs of increase. That definitely. In terms of healthcare benefits for governmental employees that are funded out of the EUTF, that one we're a little bit not as certain that the impact is going to be excessively large, but any small impact, say in the dozens of millions in the course of a fiscal year, has a ripple and exponential growth effect over the long term. So, if there's a $10 to $20 million impact, let's say, for current active employees, the impact 30 years, when you look at this unfunded liability, for instance, 30 years from now, that $10 million effect now could equate to hundreds of millions of dollars into the future. So, I would say right now I would be more certain to say there is going to be a financial impact for the result of the Affordable Care Act on the state government, more so versus than to say that there likely will be no or net zero effect after everything is said and done.
Okay. Are there, well, let me start by saying, do you have a sense of visibility right now, or is the dust still settling in a way that you really have a hard time getting a handle on what the costs are going to be?
There's still a lot of academic and theories in terms of how the costs will roll out. So we can't say for certain. It's not even really truly embedded into the state's financial plan, for example. But we know the connector starts up within the next fiscal year, and you're going to start to see some of these costs rolling in to the state. So I would say, like in the very next year's budget, when you're at the legislature, you're going to see the legislature starting to increasingly deal with these added costs. And some of them will be largely attributable directly to ACA implementation, and some others may be secondary or tertiary effects as a result.
Okay. So far, we've talked about this in the sense of the Public Worker Health Care Trust Fund. Have you got any visibility on the Obamacare or Affordable Health Care Act, how that will affect state budgets for non-state employees? In other words, the general public.
That I don't know. I'm probably not the most intelligent person to speak to that. Again, I would assume that there is going to be an impact to the average general taxpayer out there.
Okay. Well, obviously,
on the positive, I mean, on the increased cost side.
Right. If you haven't got the information, then obviously we don't have the visibility, because you would be the one who would see that. So.
Well, the Department of Human Services actually has an Affordable Care Act section or an office, and they are working with the connector, working with trying to make sure their Medicaid programs are ACA compliant. And so they have a very good handle in terms of seeing the incremental fiscal costs that are rolling in. But in terms of like how that rolls out into the overall economy, that's what we need to have better insight on.
Okay, that makes sense here. another question I was going to ask was about if we have any option of including personal responsibility in here to get people to take a little more responsibility for their own health care and thus keep the costs down, but I'm not sure if your office looks at that or not.
There is some opportunity there on the EUTF side, but also the Affordable Care Act is supposed to drive or incentivize through financial means, incentivize more personal responsibility. So if you look at a lot of the plans, for instance, it does look like they're driving even providers to be more into a more holistic preventative care construct. But that could be more costly as well. I mean, so just purely on the cost side, the fiscal side may be more expensive initially. Whether or not over the long term a wellness program will result and therefore drive down long-term costs, that would have to remain to be seen. A lot of that is largely academic, I assume, at this point.
That's a good point. And while the dust is settling, it's difficult because it's going to make it very difficult for the legislature to plan these costs in advance.
Yes.
Maybe we could shift for just a second to, you called it the ERS, the Public Workers Employee Retirement System. And we have a set of retirement policies for state workers, and those are shifting now, so new hires are hired under a somewhat different plan, correct?
Yes, so in 2011, and then again in 2012, the administration actually proposed a number of pension reform measures, largely driven as a measure to try and curtail large unfunded liability growth in the pension system up till that time. One of these reform measures was to curtail pension benefits for new but not yet hired employees. So starting all employees hired on July 1st, 2012 are under a different pension system that made a number of changes to pension benefits that really skinnied up or reduced or moderated pension benefits in the system. So some of the components, for instance, in case any of the listeners or viewers are aware, this government pension system is based on three components. It's based on your average earning over the what was the highest 3 years. So that's what your pension base was. And then you got a percentage for every year of service that was applied to that base. So for instance, someone who worked 10 years, let's say, and averaged for the last the highest 3 years of their employ, averaged, let's say, $50,000 a year, they would receive as much as 2% for every year of service. So with 10 years, they'd be 20% of the average of their high 3. So that would come out to 20% of $50,000. Well, in the pension reform measures, that the percentage was increased to, instead of 2%, it was lowered to under 2%. I think it's like 1 3/4 now. But also the high 3 was actually raised to high 5. So it takes more years to develop the average. And then the last component was how long it takes to vest. So previously it was 5 years. You have to work 5 years before you can vest into the pension system. Employees hired after July 1st, 2012 now have to work 10 years to vest. So it takes longer. It takes longer for you to get a benefit. The benefit is less when you get it, and then you have to work longer to calculate what the benefit is. So those reform measures help reduce the overall pension liability, and over the long term, because you have to wait for these employees to vest before they get calculated into the total liability of the system. But over the long term, meaning longer than 10 years, you'll start to see the overall pension liability, the trajectory to start to turn. And that's what we have to look forward to for the state. Now, keep in mind, a lot of these pension reform measures are not necessarily totally different from some of the news that a lot of people have been reading about over the last couple of years with states like New Jersey, Illinois, Indiana, Rhode Island. They also have severe pension liability issues. And you saw a lot of public and worker uproar at efforts they've tried to curtail that growth. You didn't see as much of that in Hawaii. I would say the unions have been very responsive and engaged in terms of looking what the issue is, and have worked with the legislature and for a large part with the administration in terms of crafting up reform measures that have been palatable on the workers' side. They will take longer to show results, but they're far more moderated, and they will achieve the same objective as a lot of these other states are trying to achieve. It just will take longer. So those are some of the reform measures that you see. Another big one, which was very contemporary in discussion across the country last year, was pension spiking. Pension spiking is the intention of the worker basically to enhance their pension benefit in their final years of service ahead of retirement, so that the pension benefit is enhanced significantly, but at the same time, the contributions into the pension system haven't been sustained at the level to support that pension benefit. So the pension reform measures have actually curtailed and eliminated pension spiking opportunities for employees hired after July 1st, 2012 as well. That piece of legislation is actually very, very significant on a national scale compared to what other states have been able to achieve. Hawaii actually got very good recognition in the credit markets for what it was able to achieve in terms of curtailing pension spiking opportunities. So all of these are being recognized. You know, Hawaii is doing a lot of things that's very positive for investors and for taxpayers in terms of curtailing growing costs, and that's what investors really want to see. It's what taxpayers are expecting. So we are making headway there. It's going to take some time to show the true return on that investment, but it's there, and that's what we have to look forward to.
Sounds to me like the legislature has a very delicate balance here, whereas you have existing workers who have planned on a pension, and they want the sense of security that what they have planned on is going to be coming in. On the other hand, from the standpoint of the public, there's a growing recognition that often a public worker is getting a significantly better deal than somebody in the private sector. And there are some instances where somebody can retire with 20 years of service, so they may be retiring at perhaps 41 years of age or 42 years of age, and there is a long-term liability for the state. And if this person lives to, say, let's just say they live to 82 years, which is very reasonable nowadays for a Hawaii resident, they would have put into the fund for 20 years, and then they would be drawing from the fund, being supported by the fund for 40 years. Is there an attempt to look at this in terms of how this can, because realistically, the amount of time of the life expectancy of a person now is considerably longer than when a lot of these systems were first conceived.
Yes, and to be clear for the listeners and viewers out there, all of these reform measures have not curtailed or impacted current employees or current retirees, certainly not those who were employed by the state, county, or city prior to July 1, 2012. So all of them remain untouched, and they are the lion's share of the liability out there. But this is a delicate balance because so much of our population are government retirees or government employees. So it is, and it's politically difficult for the legislature to do what is excessively necessary to curtail those benefits. That's why I think the measures that were passed are significant, because they're a very delicate moderation in terms of what we were able to achieve. And although it may take time to get there, you know, it was not as harsh on our overall society as compared to, say, some of the other states that had to get there overnight. And that's how they got there, was effectively just eliminating benefits for current retirees. So, but for the average taxpayer, what we have to realize is these are all benefits that get promised, whether it be through the statutes, the laws, or through the collective bargaining process. These are benefits that get promised, and they may seem cheap now, but they have very long-term consequences, and it's the long-term consequences that are the most expensive. And that's where we are today in 2013. We are paying for promises that were made, not by you, certainly not me. They were made decades ago, and the $1 that was required to pay them back then was not put forward. And now I'm being asked to put up 10 for a dollar that was promised 10, 20 years ago. So it's very, very expensive. But at the same time, I don't want to burden my child or my grandkids making promises that are not sustainable, that they will have to pay for. So we have to be very mindful of that, and that's where we are. And it may seem difficult today for public worker unions or taxpayers or the government to recognize that, hey, we're talking about limiting benefits for future employees, but that's the only way we can sustain them. Because I don't really, myself, don't want to pay more taxes. I haven't met anyone yet who's wanted to pay more taxes. And we live on a very small island state, so we don't have a lot of tax revenue pool to draw from. So we have to be very mindful of and very cautious of how much we can actually expend, especially into the long term.
Yeah, it's a tricky balance, especially because as we look at both the retirement benefits and the health care, we see that as new medical technology comes along, there are a lot of procedures that were never envisioned 20 years ago. They're extremely expensive,
Yes.
but can sustain somebody's life quite a bit longer, which means more retirement pay,
right.
more health care costs.
So, and your point is actually very well taken. It's not uncommon. It is not uncommon for a retiree to actually be collecting a pension or a health benefit in retirement longer than when they were employed. So they haven't contributed as long into the system as long as they are going to be collecting a benefit. And it's very comparable to the Social Security system. The pension system that I described to you folks earlier is a defined benefit program. With the exception of the public sector, there's very, very few, if any, private sector companies that still offer a defined benefit program for their retirees. So government workers are very fortunate in the sense that it's still a benefit that is offered to them. So we want to make sure that's preserved and funded adequately so that it's sustained. And that's really the issue.
Well, that's the problem, and the private sector has recognized that this is not easily sustainable.
It is not easily sustainable.
And,
it is not.
And that's a very, very tricky balancing point,
Yes.
especially because we don't understand the new medical technologies and the costs. Nowadays, somebody gets cancer, there's new treatments that can extend lives, but the costs are absolutely horrific.
Right.
So,
from an actuarial standpoint, one of the biggest cost drivers on an actuarial table is life expectancy increasing, and
yes.
that's what medical technology has done. You see growth in the longevity of just a population base. That really changes everything. I think when Social Security was first created, the prospect of someone collecting Social Security wasn't longer than 5, maybe 10 years. Now you have people living twice that, to their 90s, and Social Security was never meant to support that long a term of life expectancy. The same is true in the pension system, in Hawaii's pension system. So, and unfortunately, Hawaii taxpayers have to contribute into supporting the pension system. So, one thing has to be done about sustaining it, and whether that's supporting the current existing benefits or looking for some restructuring of the benefits for future employees that make it more sustainable or more likely to be sustainable. I think that's something the state of Hawaii is going to be discussing in the very long future.
we have a real hard time when we have basically unanticipated consequences that we have to look at the fact that, as you say, probably when Social Security came in, the life expectancy was not much more than, I mean, it was around 65 years.
Yes.
And nowadays, it's not at all uncommon for somebody to live into their 90s.
Yes.
So, and the healthcare costs continue that entire period.
Yes.
So, okay, let's shift gears for just a little bit. There are some other new programs that were brought in, such as early education that the governor has been pushing. Can you just give us a little bit of an idea what that's going to cost, what the prospects would be? How does that look?
Well, this is a good program that the governor has proposed in his budget. Right now, as we head into the conference committee session of the legislature in the final 3 weeks, you're going to hear a lot of discussion about it. The governor's proposal initially was to fund an early childhood and an early learning programs that would start off costing somewhere about $20 million a year in its initial year, and moving up to about $45 million in its second year. Those are big price tags, admittedly, but it's largely driven by a measure passed by the legislature several years ago that would raise the age for children to start kindergarten, where kids can't enter kindergarten unless they're age 5 in August of the year that they start. So when they made that move, previous to that, you could start kindergarten as young as 3 to 4. So now you have a situation in the inaugural year where you're going to have this block of parents and kids that are going to have no access to basically getting their children into school. The bigger social issue there is Hawaii needs to do a better job of getting our children ready to learn.
Yes.
And early childhood education and those types of programs help that. We're asking the Department of Education, for example, to increase student learning, achievement, statistics and metrics in there. But a lot of times kids are not ready to learn. And so Hawaii kids really are at a disadvantage in that regards. Well, the early learning and the early childhood program would have created an opportunity to take these kids as young as 3, 4, and into the 5 years and provide them an early learning option that would increase their readiness to learn. So when they get into school in kindergarten, they are better prepared. That has been challenged at the legislature in terms of where the governor had proposed and what the legislature has been willing to support thus far, both on the House and the Senate. But I think it's good in the sense that the legislature has at least left open the doors of discussion for what this program could and may look like. I don't think it's going to get funded to the level that the governor had proposed. And I think the legislature will have some thought in terms of what the program ultimately looks like in the inaugural year. But I'm pretty optimistic that the legislature as a whole sees the value in early childhood education. And the real question will be, do we have the commitment and the fortitude to support that concept with funding? And that's a very big question, and one I think the legislature rightfully should think about, because we talk about sustainability here. We've been talking about it all this afternoon. This program will likely not stop at $40 million. I mean, you have to think about it. The Department of Education has a budget in excess of $1.3 billion. This is the tantamount to adding another grade. So when you think about K through 12 education, and now adding early childhood, I don't think it's unreasonable to think that if you want this program fully running, if that's what Hawaii wants for our children, I don't think that it stops at 40 million. Because if you do the simple math, this could very easily and very reasonably look like a $100 million program in the long term, on a fiscal basis annually. So that to me seems a reasonable expectation. We really have to work through some of the discussion about, do we want to commit that much of funding towards something as motherhood and apple pie as early childhood?
Well, we have a situation where we have big benefits, especially to kids that are not as fully prepared at home as other kids who come into classes not quite prepared to learn. But so obviously this is something of great value here. But are we talking about a program that would be completely publicly funded, such as a normal grade, or are we talking about something where parents might contribute something? Because obviously, if you take children in earlier, you're taking away the need for babysitting. So is this total public funding, or is this partial?
It is not totally publicly funded, but there is a needs-based criteria in there. So, and how this evolves over, we're talking about the initial year now. So what this program is 5 years from now might be very different than what it looks like in the inaugural year. We need to get some growth in there into the evolution. So that's all part of it. What are the societal mix of who's going to be able to benefit from this program, whether or not it's needs-based, or if there is even a financial needs component in there. So a lot of these have to get more thoroughly evolved, and it's going to take time. I think the legislature right now, I would bet the legislature's content to let's see how it grows up. But the real key will be getting initial funding to start that process. Otherwise, we're talking about only a fraction of our children will have the availability of getting into an early childhood, early learning situation.
That's a really good point. Before we run out of time here, there's a couple of things I'd like to ask you real briefly here. You folks hit a home run, from the sound of it, with your bond refinancing, cutting the cost to the taxpayer. Maybe you could give us a quick run through on what happened there.
Well, this is our program for the last 2 years with the start of the Abercrombie administration. Just coincidentally, the financial markets have been very favorable to bond issuers. The credit interest rates have been low and declining for the last 2 years. So in 2011, we took advantage of some low rates at that time to refinance in excess of $400+ million worth of existing bonds at that time for very low interest rates in 2011, the result of which saved the state of about $76 million. And then the credit markets had continued to improve for us. So in 1 year later, in November of 2012, we actually refinanced another $300+ million in outstanding bonds. That would result in about $46 million in savings to the state. So the benefit there has been that taxpayers are obviously the beneficiary of that, because we are paying less debt service, i.e. less taxes, to these already existing debt. Just another caveat about we're making our tax dollars go farther. So we're doing more with what limited dollars that we have.
Well, it's good to see you get some recognition here for something that's saving the taxpayer a very significant chunk of change here. So
we want to be prepared when the opportunity provides itself. We want to be able to jump on it and make sure it gets to the benefit of the taxpayers.
Excellent. Another question. This is just some people in the public basically. Well, there's a constant discussion about legalization of gambling here, and it sounds to me like it's a real double-edged sword, whereas you have to, you can get additional revenue, more people coming in, but there's a cost for this. Maybe you could address that real briefly.
Well, I'm not an expert on the mechanics or the economics of gambling, but I think there's good evidence on both sides that it could be positive, but yet there are definitely going to be some impacts, and whether or not they both result in additional revenues to the state, that is really largely debatable at this point still yet. We see a lot of locales that already have gambling. For me, economics of it, you kind of look at, well, a visitor has a limited amount of spending opportunity and spending dollars. If they spend that dollar that they have on gambling, they're not going to spend it on other activities. So whether or not that results in a net positive for the state, whether people will spend more money as a result of gambling, that we don't really know. And I think there's people that will look out in that study to find that out. But at the same time, a lot of people say, well, locals will travel to Las Vegas and spend a lot of their dollars in Las Vegas as opposed to spending it in Hawaii if they could gamble. And again, that's true. So if we look at the economy that way, in the sense that I want to entice the public resident to spend more of their money into our economy, yeah, maybe that's arguably true. But whether or not gambling is the right mechanism, I think that's a policy and a societal issue that still has to be addressed. So that's a very big question. I hope that the legislature will engage more thoughtful discussion amongst all of the interested groups into the merits of gambling before we start exercising on that option.
So your opinion basically is that both sides have good arguments, but the jury is still out. It needs to be looked at much more carefully.
Yeah, I look at it from an academic standpoint, so
Right.
It looks very good. But I personally like to gamble, and I like to go to Las Vegas. So that's my disclaimer. But whether or not I like to gamble in Hawaii, that's something I reserve. I'll have to reserve. So
Okay. So some benefits and some things to be wary of.
yes,
Okay.
it's a very big decision for Hawaii's long-term future.
Okay. We're coming toward the end of the show here, and I wanted to see if you had any final comments about where we're going. Obviously, you've had some great points about getting us prepared for a down cycle, taking advantage of when we're in a down cycle and planning ahead. Would you like to finish up on that, perhaps?
Yeah, so I talked to a lot of community groups and a lot of people, and what everybody needs to understand is that we're very familiar with economic cycles, but we have to understand that there's also financial or fiscal cycles as well, and they're not always the same as an economic cycle. Hawaii is just like every other state. We're very short-term memory when it comes to the up cycle. We forget how hard it was during the down cycle. When there's an up cycle and you get a little bit more revenue, everybody wants to spend the money as quickly as possible. But we very frequently forget how difficult it was, just in recent memory, how bad it was when we didn't have the revenue. So what I like for people to remember is, before we start talking about what new programs, new initiatives we want to start, we should ask ourselves, what is the value equation if this program is sustainable at the next economic down cycle? And are we willing to do what is necessary during the down cycle to support it? Because as any savvy business owner will know, the time to reinvest in your product is during the down cycle. Opportunity is cheaper at that time. You can get a lot of long-term benefits for a limited amount of dollars. And that way, when the economic upcycle comes, you're ready and poised to launch ahead of your competitors. That's how Hawaii should think of itself in the form of government as well. We haven't really done that. We haven't really thought into the long term. But I think we're starting to, in the last 2 years, I can definitely see a trend where we are looking in terms of addressing what are the long-term equation problems. And so I'm very optimistic about the future for Hawaii. And really, with everybody's discussion, as yourself, the discussions you lead, I think you'll see people being much more engaged with higher levels of aptitude in terms of what is the long-term prospects for Hawaii.
I like that approach. That makes a lot of sense to me, because it's the kind of thinking we need right now. So I very much appreciate your taking the time off. I know you're very busy, and it was difficult to get you to come in here on short notice and present this to us, but I really believe that it helps the voter in the state make informed decisions when they have to contribute their input to their legislatures and such. So thank you very much. Our guest tonight has been Kalbert Young, Director of the Hawaii State Department of Budget and Finance, and this is ThinkTech TV. Thank you very much for coming in and joining us, and we look forward to seeing you in the future. We can be found at www.thinktechhawaii.com on the internet, and you can get our live stream and see us on OC16. Thank you for joining us tonight.